The gold price jumped by over $100 in 90 minutes. You can actually see it on the screen behind me, and it's over $100 up at the moment. The rise came immediately after the US Treasury released an announcement on its website, and I'll read that announcement to you, the beginning at least. It says, "The US Department of the Treasury is increasing by at least double the size of liquidity support buyback operations for longer-dated nominal coupon securities, the 10-year to 20-year sector and the 20-year to 30-year sector. The current minimum size of $2 billion per operation will be at least $4 billion per operation. This change is effective September the 9th and will be in effect for the remainder of this refunding period through to November the 4th, 2026. So that's the beginning of the announcement, and as they made that announcement, gold shot up, as you can see on the screen. And I'm going to interpret that because it's obviously quite difficult for many people to understand, and understandably so. They talk in a language which is not really made for the layman. So, first of all, this is not the first time they made an announcement like this. On the 13th of August, that's 6 days ago, the Treasury had already doubled the frequency of long-end liquidity support operations. They doubled it from 2 per quarter to 4 per quarter, and they lifted the total liquidity buyback capacity from 30 billion to 38 billion. So in the space of 6 days, the Treasury has doubled how often it buys long bonds, and they have doubled how much they can buy each time. Just before the announcement today, the 30-year yield was at 5.34%, which is the highest yield in 20 years. So behind me, you can see the spike in the gold price. It's pushing on as I speak this at just coming up to 7 o'clock, a few minutes away from 7. It's pushing up at 4,400 and what price do I see on the screen now? 4,494, the peak being 4,498.40 a few minutes ago. So all eyes are now on September the 14th, when the hold on the Fed buying new treasuries comes to an end. Will they start buying treasuries on that date? If they do, the gold price will go ballistic, in my opinion. That's all I've got to say to you, ladies and gentlemen, today, but thank you very much. Please like and subscribe if you want me to keep you abreast of developments as they happen in the gold market, in the Treasury market, and of course, if the federal fund interest rate gets changed at any time.
Larger, long-dated Treasury buybacks point to officials paying closer attention to liquidity and stability further out on the yield curve. With the 30-year yield pushing to such elevated levels, it stands to reason that investors are turning to gold as a store of value hedge. The bigger question is what happens once the Fed's restrictions on Treasury purchases shift in September. Any renewed intervention there could turn into a major catalyst for gold. Ahead, why the Treasury looks to be taking action while the Fed holds back. What further increases in long-term yields could trigger, and where the Treasury's purchasing funds might be coming from.
The Federal Reserve is standing still. It's done nothing. It's said nothing. It's not riding to the rescue. In fact, on the 13th of August, 6 days ago, the New York Fed announced that it would buy nothing at all between 14th of August and 14th of September. In other words, for a whole month, and we're in the middle of that month, and it's not buying, and it's sticking to what it said it won't buy. So what's going on here? On the fiscal side, that's the Treasury, the government, if you like, it is intervening in the long end, trying to keep long yields from rising anymore. Probably, at least, let's put it another way. So, the Treasury is intervening at the long end, and the Federal Reserve still has got its hands in its pockets. It's doing nothing. So, what's this mean? It means that probably the Treasury has got some sort of unofficial line in the sand as to where it regards the 30-year yield as being too high. And I'm saying perhaps that's a level anything above 5.30%. We're just above 5.3%, or we were just above 5.3% when they made this announcement. So the Treasury has not made any announcement as to where it thinks yields are too high. So it's just speculation that 5.3% is the level where it regards as yield as being too high. Now, as the Treasury buys these longer dated bonds, it has to fund those purchases from somewhere. And it's almost certainly going to fund those purchases from the short end of the market. That means the Treasury bill market, which is 3 months, or the Treasury note market, which is 2 years, something like that. So at first sight, you might think the Treasury's refreshing its funding at a lower rate than the 30-year. Well, it's not actually working quite like that, because most of this refinancing of long-dated debt will be maturing debt, which was taken out when yields were 2.5% or 3%, and they're now going to be they'll retire that debt, but any new debt they take on will have to be at a rate high 3s to low 4s for the next few weeks anyway.
The split between what the Treasury and the Fed are doing matters here. The Fed is holding back while the Treasury works to keep longer-term yields from climbing further. The fact that the Treasury is essentially capping pressure on the 30-year shows just how sensitive that end of the curve has become. And if those purchases are funded through shorter-dated securities, it may simply be relocating pressure within the Treasury market rather than easing it. Ahead, what full yield curve control would actually involve, why the Fed would need to shift policy first, and what that could mean for gold and treasuries.
Now, what's the next logical step? And the reason I'm going to tell you the next logical step, because this will start to explain why gold is reacting. The next logical step is fuller yield curve control. And to get full yield curve control, you need the Fed to do it. It's not the Treasury which can do it. So real yield control means that a central bank, the Federal Reserve in this case, stands ready to buy unlimited quantities of long-dated debt at a target yield. Let's call it 5.3%. The Treasury can't do that. It can do it a little bit of it by buying selling shorter date yields, but it can't do it ad infinitum. Only the Fed can. But the Fed, as I said, is currently walking the other way. It's not buying long-dated bonds. So for the yield curve control thesis to play out, the Fed would have to reverse its present position of saying it's not going to buy anything for a month. It's going to reverse the position it announced just 6 days ago. And don't forget, we've got a chairman who wants the balance sheet to get smaller. We've got a committee where the dissents were actually asking for a hike, 3 of them. So a reversal of the Fed's stance could be possible, but not according to their words for the moment, at least not in the near term for the next 30 days or so.
That's what makes this more interesting. The Treasury's actions so far are still modest set against what full yield curve control would actually require. Should long-term yields stay under pressure, the key question turns to whether the Fed eventually has to step in and backstop the longer-dated Treasury market. A targeted yield level held up by potentially unlimited Fed purchases would be a much bigger policy shift. And with the Fed currently focused on shrinking its balance sheet, that outcome is no simple task. The friction between mounting bond market pressure and the Fed's current posture could end up mattering a lot for gold. Ahead, why markets may already be pricing in a Fed policy shift, how renewed purchases and fresh liquidity could reprice assets broadly, and why gold could be among the biggest winners.
Now, if the Fed does eventually join in, and that would come probably if they stick to their word after the 14th of September, it would buy bonds, long-dated bonds, with new money that it creates. And this is why the gold price has risen so much today, because the market is now anticipating exactly that end game. The market is anticipating that at some point, the Federal Reserve will step in to help the government by buying long-dated bonds in the market to keep the yields in control and simultaneously printing money to buy those bonds. That's QE, or quantitative easing, which obviously creates a lot of money on the planet, and that money will find its way into other things, specifically assets, potentially a little bit of inflation too, but mostly it will find its way into assets, pushing up the price of assets which are in demand and relatively rare. And that, of course, could include the stock market, it could include gold, it could include many other things which people value and are tangible, of course, and works of art and things like that. But I think that the gold market is one of the easiest places for people to redeploy their cash when they see a surge of new cash coming into the market down the line. Now, this, of course, is just speculation. It hasn't happened, but it's what the market thinks is likely to happen.